Hello and welcome to Smart Finance Investor. In today's video, we're diving deep into a topic that's of immense interest to investors and traders alike: initial public offerings. Whether you are a seasoned investor or just getting started in the stock market, understanding initial public offerings is crucial. So, let's demystify initial public offerings together. Section 1: Definition and Importance. An initial public offering occurs when a private company decides to make its shares available to the public for the first time. This is a significant step as it marks the company's transition from being privately owned to becoming a publicly traded entity. The importance of initial public offerings cannot be overstated. They offer companies access to a broader pool of capital, which can be used for expansion, research, development, and other growth opportunities. For investors, initial public offerings provide a chance to invest in a company's early stages, potentially reaping substantial gains if the company succeeds in the market. Initial public offerings often capture the attention of both individual and institutional investors due to the excitement surrounding new companies entering the market. These offerings can also influence market sentiment and trends, making them a crucial aspect of the financial landscape. As exciting as initial public offerings are, it's important to approach them with careful consideration. Companies going public may experience shifts in their corporate culture and priorities, impacting their operations and strategies. Investors need to weigh the potential for high returns against the risks associated with investing in companies with limited trading history. Section 2: Benefits and Risks. Now, let's navigate through the landscape of benefits and risks that come hand in hand with investing in initial public offerings. On the bright side, successful initial public offerings investments can yield substantial gains as the company's stock value potentially increases post-listing. However, it's important to approach initial public offerings with caution. One major risk is the potential volatility that new public companies face in their initial trading days. Limited historical data might make it challenging to accurately predict how the stock will perform. Furthermore, investing in an initial public offerings requires thorough due diligence. The absence of a long track record could hinder accurate assessments of a company's management, financial stability, and long-term potential. Balancing the allure of early investment opportunities with the caution of unforeseen market reactions is key. Section 3: The Initial Public Offerings Process. We will unveil the fascinating journey a company takes when it decides to go public through an initial public offering. First, the company selects investment banks to underwrite the offering. These banks play a pivotal role in determining the initial public offering's offering price, creating a comprehensive prospectus, and marketing the initial public offerings to potential investors. Once the regulatory approvals are secured, a specific initial public offerings date is set. This date marks the day when the company's shares become available for trading on a stock exchange. It's a significant moment that often garners substantial attention from investors and the financial community. Throughout the initial public offerings process, the company's financial health, growth prospects, and market sentiment play integral roles in shaping its outcome. The initial public offerings process is a well-orchestrated dance of financial, legal, and marketing activities that culminate in a company's transformation into a publicly traded entity. The intricate steps involved, from selecting the right investment banks to coordinating with regulatory bodies, showcase the complexities and strategic considerations that companies must navigate to successfully make their mark in the public market. Section 4: Factors affecting initial public offerings pricing. In this section, we'll unravel the key elements that influence the crucial decision of setting the offering price for an initial public offerings. Several factors come into play, including the company's financial performance, growth potential, and industry trends. Investors and underwriters assess valuation metrics like the price-to-earnings ratio and price-to-sales ratio to gauge whether the initial public offerings is attractively priced in relation to the company's earnings and revenue. Market sentiment also plays a vital role. Positive market conditions can lead to higher demand and better pricing for the initial public offerings, while volatile or bearish markets might require adjustments to ensure a successful offering. Striking the right balance between offering shares at an appealing price for investors and raising sufficient capital for the company is a delicate art that requires a deep understanding of both financial data and market dynamics. Section 5. How to evaluate an initial public offerings. Start by thoroughly examining the company's prospectus, which provides insights into its business model, financials, risks, and management. Research the industry landscape to understand where the company stands in terms of competition and market trends. Analyze the company's growth strategy, including its plans for expansion, innovation, and adapting to evolving market conditions. Look beyond the excitement of the initial public offerings and consider the company's long-term potential. Assess the quality of its leadership and management team, as their decisions will greatly influence the company's trajectory as a publicly traded entity. By evaluating the initial public offerings through a comprehensive lens, you'll be better equipped to gauge its alignment with your investment goals, risk tolerance, and overall portfolio strategy. Section 6. Tips for investing in initial public offerings. First and foremost, align your investment goals and risk tolerance with the specific initial public offerings opportunity you are considering. Diversification is a golden rule. Spread your investment across different asset classes to minimize risk and avoid putting all your capital into a single initial public offerings. Consider a patient approach. Instead of jumping in on the first day of trading, give the initial public offerings some time to settle and gather more information about its performance as a public company. Thorough research is your ally. Scrutinize not only the prospectus but also external sources for a holistic view of the company's industry, competitors, and potential challenges. And there you have it, a comprehensive guide to initial public offerings. Whether you are excited about the potential gains or navigating the associated risks, understanding the initial public offerings process is a valuable skill in the world of investing. If you found this video helpful, don't forget to give it a thumbs up, share it with your fellow investors, and subscribe for more insightful content. Thanks for watching.